So welcome. So first, briefly, tell a few words about your relation with markets, with finance.
Thank you very much. I've been in finance all my life. So straight from university, I joined Goldman Sachs, initially in New York and then in London. From there, I went on to join the board of Merrill Lynch International Bank, which was a subsidiary of the parent company, but looking after Europe and the Middle East. And from there, I basically entered into the life of an entrepreneur. My businesses are in different fields, but I think I might even have some colleagues here who run the biggest private asset management company in the Baltics, Trigon Asset Management. So we manage in that company over 1 billion euros, with the biggest investor in our asset management company being the Norwegian Sovereign Wealth Fund, which is extremely well known for being very, very good at picking fund managers. So I've also invested into buying entire companies. I think we are the largest milk producers in Europe these days, in the European Union. And I've got property interests in different parts of Europe. I've invested for my sins in lost a lot of money as well over the years, and invested in Africa, lost all that money. Invested in Russia, lost all that money. So, as always, I've had successes and I've had failures.
So you can blame me for this panel being in English, right? I'm the only non-Estonian on this panel. But I'm Alejandro Jimenez, and my relationship with finance historically, I was a partner at JP Morgan. I spent close to 20 years in that firm, mainly based in New York City, spending some time in Geneva, Switzerland as well. So I've been following markets essentially since the 90s, but I've studied a lot of market history as well as part of my job in banking all those years. And then I moved to Estonia to join the startup sector, so I was involved with several startups. And today I'm in the energy sector now. So always keep learning, and even in midlife you can have a career change if there's a sector that you really like, and energy is one that I really like right now. So I work for Eesti Energia, and I'm part of the energy trading group and sourcing green energy for our customers.
Yes, I have one more name to add to this list: Goldman Sachs, JP Morgan, and LHV Bank. So I'm Nelli, and I'm head of investor community in LHV Bank, and I've been connected with the financial markets, or especially US market, for the last 16, 17 years. I was 11 years was working as a US stockbroker, the only female stockbroker in Estonia, may I say. So, here I am.
So first question, I think I will ask you the biggest question in the world. And for this, I asked to present a picture on the screen. So the biggest question in the world. How you answer it in a global economy perspective? What will happen?
Well, let's talk about Maganomics, right? Trump, Make America Great Again, MAGA. So what is Maganomics? And the core of it is to make products in America, supply chains in America, give jobs to Americans. And the pillars of this Maganomics, I would say, are tariffs, right? So you're imposing a tax on the imports of foreign products into the US. Deregulation, so you're going to cut red tape, make it easier for companies to be able to enter into acquisitions. Banks will probably have more capital to lend as you deregulate the financial sector. Easier to get oil and gas permits, etc. Taxation, keep taxes low, keep America competitive in that sense, and immigration. Get rid of a lot of foreigners who are there. That's the policies. But you got to remember that with Trump, he views everything as a transaction, right? He made his living in New York City in real estate. So everything he approaches is as a transaction. So you got to negotiate with him. And I think in the short term, it's going to be good for the US because it creates a lot of optimism in that sense. And I think the US outperforms economically because of that. And it's definitely going to hit Europe and China because he will impose tariffs if the Europeans and the Asians or the Chinese don't do as he says. Now, there are consequences to that as well in the longer term, potentially inflation, potentially deficit increases. But I would say that because of Meganomics in the short term, there's a lot of optimism in the United States right now from small businesses, consumers, vis-a-vis Europe, Asia, Latin America.
But, maybe it's related to Trump, but maybe we can take a step back and look at the really big picture because it's a big part of what America is all about today. If you look at most forecasts, of population in the year 2100, it's very interesting. The forecasts are showing that America, which today has, 340 million people, will have 400 million people, or thereabouts. China, which today has 1.4 million people, will have maybe 600 million people. Europe, which today, the European Union has about 450 million people, will be down to about 420 million. Now, what is happening, and what does that show? It shows that America is dynamic. Europe is not that bad either. These are the two big economic areas in the world that accept immigration. If you ask people anywhere in the world, you go to Africa, you go to, South America, you go to, Russia, wherever, where would you really want to live? They'll say America or they'll say Europe. Nobody wants to move to China. Nobody wants to, move to Russia. Nobody wants to move to India, for that matter. So what we're seeing in the big picture is a dynamic. Of which the biggest beneficiary is the USA, America. And Europe is not really that far behind, as much as we seem to be and tend to be pessimistic about our own opportunities versus America. The rest of the world, has huge problems coming, China included. And clearly, if you look at investing in the world, long-term matters because it's the long-term trends that guide, what is happening short-term. There are ups and downs short-term, but it's all driven by long-term trends. Trump is probably in the longer term going to be seen as a blip. He will be very important for the next couple of years, but in the longer term, he's just part of what's happening in America, part of what's happening in the world. And he's not going to change the fact that America is the most dynamic, large economy in the world. But he will present us with challenges. And as Alejandro said, I think that short term, it's maybe good news, but I would steer way clear of US shares, for example. I wouldn't touch them with a barge pole, because what I think is going to happen is the Trumponomics is going to lead to a sharp increase in inflation for reasons that we can talk about later, maybe.
Nelli, would you touch the US stocks after Trump enters the White House?
Yeah, I think the main question with Trump is how much he's bluffing. Because if he's going to do everything that he promised to do, then I think there could be quite long consequences in the US economy and on the markets as well, especially the game with the tariffs, because that actually could spark a pretty serious trade war, which is never good. But he also, as said, in short term, it's probably going to be a positive trend on US markets. And at the moment, the fundamentals of US economy is surprisingly strong. US economy has survived a pretty long high interest era, and the much feared crisis never came. So at the moment, we could say that AI or technology sector saved the day, but it's not something that cannot be, destroyed with maybe not so wise decisions. So what I think we'll definitely get is much more volatility. Much more volatility this year, but as we were just talking before the performance, that it really depends in what mood Trump will wake up in the morning.
As you said previously, all of you've been in finance, if not mostly like almost entire life. So you've seen many corrections, many crashes. And two things that are popping up in the financial media in the world right now is this picture, that the bond yields are going up, which is like one of the predictions of the bear market. And another one, obviously, is Shiller's PE ratio, cyclically adjusted earnings rate. So those charts, they don't look the most beautiful, I would say. But based on those charts, would you predict coming bear market?
Absolutely. It's obvious. It's not just those charts. If you look at, let's say, the SP 500 is the best sort of index to look at because it covers so much of the sort of the regular U.S. economy. I mean, you have to view the Magnificent Seven as a sort of a standalone. But if you look at the SP 500, we're at all-time highs in terms of price to sales. We're at all-time highs, at least this century, in terms of price to book. The Shiller PE ratio, which is in the region of 30, its average at what is considered reasonable is 15. So it's way, way, way above where it should be. A ratio that I tend to look at is the PEG ratio, which is the price-earnings ratio divided by expected the expected growth rate of profits, the EPS growth rate. So if you have a PE of 20 and you expect the profits to grow by 20% per annum for the foreseeable future, you have a PEG of 1. 1, it tends to be like something that people consider to be normal. If it goes below 1, then it's a good buying opportunity. If it goes above 1, 1.3, whatever, then it's it's overvalued. Today, the S&P is 1.5. If you look at the Magnificent Seven, the most expensive share has a PEG ratio of over 5. Amazingly, one of them has a PEG ratio of below 1. But we're set for a major, major correction. I mean, I wouldn't touch the U.S. market with a barge pole.
Few headlines.
Yeah. So I would say, I saw the hands that a lot of people are beginning investors. So markets practically fall every year within a year, right? If you look at the S&P 500, on average, inside each year, the market falls 14-15%. So a correction of that magnitude is normal. Yet the majority of the years, the S&P recovers and ends up positively. So it's been like that for almost 100 years. So if you've invested for 100 years in the S&P 500, your annualized return is roughly 10%. So I keep a long-term perspective. So listen, it's very hard to predict what happens in a given year. I don't invest that way because I hope to still be alive at the end of 2025 and continue investing into 26, 27, 28, and I take a really long-term horizon. So if you go back to the chart, the previous one, I looked at it this last night. That peak that you see in 2000, if you had bought at that peak, at the worst time, the most expensive time, and you were still holding that position today, you would still be up 8% per year, 8% annualized. So you're never going to get the timing right. It's really hard to get the timing right. Even the experts get it wrong a lot of times. In fact, 90% of US fund managers tend to not do as well as the S&P 500. So, keeping a long-term perspective, I'm very optimistic, the US stock market. I think the companies there and the level of innovation that you have in a market that size is really exceptional, and I don't see that changing, over the next few decades. So I'm actually quite optimistic. But what happens in 2025? Yeah, there's no denying that valuations are very expensive. So there's very little room for error this year. And on the next chart, if you look at that, the previous one where you were showing the bond yields going up, I think, I look at the 10-year Treasury a lot, and if it goes to 5% and stays consistently there for the whole year, I think that would be a bad sign for the market, because I think the market would be saying, Trump, your policies, we view them as inflationary and deficit increasing. But anything below 5%, I think, could be pretty good for the market. But yeah, it's going to be a tough year because of those valuations.
Yes, markets are definitely fairly valued. Are they overbought? I'm not so sure. But yeah, there is very little room for error. But one thing what we know about Trump is he cares a lot about markets' performance. So this is one hope that he's not going to make any too wild decisions, because markets don't care, they will react. And but the other thing maybe is that it's a hot topic is the AI, and is it a hype? Will it last? Is it over? I think with megatrends, and I think that AI is definitely a megatrend. There is a thing that we tend to overestimate those megatrends in the near term and underestimate them in the long term. So I think this will carry on. Maybe it's not about finding a next NVIDIA. Maybe it's now time to broaden this horizon, because, well, the latest news, as we know, Microsoft decided to invest $80 billion into data centers. Data centers need maintenance. And there are lots of companies that will gain from all those data center hype this time. And data centers need, I don't know, cooling. There are maybe service providing companies. So there are lots of services that they need to provide. Plus, data centers need lots of energy to keep up. So this is maybe one direction to look at if we are talking about maybe sectors that will actually grow in the future or next decade as well. Of course, there will be corrections, but it's part of the game.
So when we looked at performances of different asset classes, this is from 2000 to 2010, so 10 years performance. And just to translate, because it's in a short version, first is real estate investment trusts, companies in US whose income comes from the real estate. Then there's emerging markets, mid-cap companies. It's between 2 and 10 billion. Then is treasury inflation protected securities. Commodities, equal weight portfolio, so you have it strategy where all the different securities are weighted in a balanced way. Then you have bonds, cash, and large cap companies, 10 billion and more. So this is 2000 to 2010, and we see that real estate dominated. Emerging markets, mid caps, and the large cap companies, remember the Lehman Brothers, it was the last. So we fast forward 10 years, to 2025 at the beginning, the large cap companies are dominating this decade. And we see commodities have done nothing, bonds, cash, more or less meaningless. So if I ask you now where to allocate for the next decade, what you would say?
Well, decade is a very long period. I think there's going to be volatility over the decade. But if we talk about what I think one should be looking at now. So if we start with the US, as I said, I wouldn't touch stocks, shares. But you know, if tariffs and Trumponomics, whatever, lead to a rise in inflation, which I think, you know, he's going to have to put some tariffs on, maybe not as big as he's talking about, but we're going to see an increase in inflation, which means that bond yields in America are going to go up. That's for sure. Bond yields are going to go up. Stock prices are going to go down. But America is still a I mean, it's the most dynamic part of the world economy. It's no doubt. So I would be in America, and the dollar is going to rise this year. So I'd be looking at you know, various ways of getting exposure to the property market in the States, real estate trusts, why not? And I would be looking at just maybe potentially holding, you know, getting some exposure just to the dollar, maybe holding cash or something in dollars if you're a euro-based investor. Away from that, when you look at Europe, for example, I think we've had the best times in terms of local bonds here, as you were saying, in the Baltics. You know, that opportunities has come and gone. I'd be looking at dividend stocks. You get dividend stocks in Europe that can yield 6-7%. Very solid companies with extremely strong positions in their own respective markets. So there is relatively little downside, but it gives you good cash yield. And if stock markets do rise, then at least you've got exposure to the stock markets. I would totally avoid all these cryptos and everything, which cryptos are basically good for Russia and criminals, nobody else. So, you know, I would avoid that. You know, so I think although property is out of fashion, I tend to be like a property guy believer, because I see, you know, that's how you can play the long term. Short term, I would steer clear of, for example, US stocks, and I would wait. You know, if there's a big sell-off, that's the time to go in.
So I think if you look at this table and the one from the previous decade, the equal weighted, the EW, is kind of the one in the middle. So I think that the first thing I get from this graph is about portfolio diversification. If you want to lower the risk of your portfolio, if you can't tolerate high volatility, then that EW of a lot of different asset classes really helps you navigate and make some decent money. But me personally, I love the US for the next 20, 30, 40 years. So I'm definitely, and I've been buying the US, you know, for over 20 years now, and some positions I never sold, I still own, and it's been one of the best decisions I've ever made. So start investing young, that's another message, but essentially, you know, I like how the US stock market and the dynamism that it brings for decades to come.
Yeah, nothing original to add, because I can't see any serious competitors for US in the nearest future, really. So as long as the different asset classes are concerned, I think this is the place when everyone should take their own personal road, because it really depends what is your risk tolerance, what is your time period, what is your aim. So at some point, all those asset classes probably will be hot in the next 10 years. So it's really should be personal road in that matter. But yes, I think US market will offer the most opportunities for the next decade.
Thank you very much for your insights.
Thank you.
Great applause. We still have time for one question from the audience. You can raise your hand and the microphone will go. We didn't touch the Baltics. Just very briefly, what do you think Tallinn Stock Exchange will do in the short and long-term perspective?
It's what the Baltic Stock Exchange would need would be some sort of a real growth story. It's like that has like huge potential, and I don't, except for of course some very good banks. It's very hard for me to get very excited about the Baltic stock markets. It is going to be an okay place to invest, and I think there are some very good stocks if you want to play dividends or something. I would really look beyond the Baltics at the entire sort of New Europe, because that's where I see some of the most exciting opportunities in the near term. The coming months, for example, there are some stocks that have a link to the Ukraine that are somehow influenced by the war in Ukraine. And if the war were to end, there could be just an explosive growth in these stocks because they are dirt cheap. I mean, you're talking about stocks that might be trading at a PE of 2 or something, and there are stocks that have more cash on their balance sheet than their market cap is worth. So, I'd be looking for those, like in a slightly broader basis, those special plays.
So you'll hear a lot about the Estonian market in this conference, but I'll touch on the Estonian startups because, part of what I think was very attractive about Estonia, what you would read a lot internationally, particularly in my New York days in the 2010s, you'd hear about a thriving startup sector, Estonia being a really advanced nation digitally and in innovation. And unfortunately, I feel we've lost some of that with the heavy recession that the startups are facing. But I'm optimistic that part of the deregulation from the Trump administration will trigger more mergers and acquisitions, allow more IPOs, more cash outs, and this benefits the big funds, like the private equity funds, the venture capital funds, because then they can sell off the companies that they own, have new cash and reinvest. So I think there's a lot of good startups in this country and across the world that are looking for cash, but the funds simply don't have the exits. But I'm really hopeful that with an increase in M&A activity, that begins trickling down from the stock market to the private equity funds, to the venture capital, to the startup sector.
Bolt. If we could get Bolt to list on the Tallinn Stock Exchange, that would do it.
All right.
Yeah, I just say we need more IPOs and some clarity with the global events. And if that will happen, then yes, we could see our next golden era on Baltic markets.
Let's hope that will happen. Thank you.
Thank you.